What's up everyone, it's Graham Stephan, and welcome back to the channel. Today we're diving into investment mistakes that could cost you thousands. Even small mistakes can snowball into significant losses. I'm here to help you make smart investment decisions. Let's get started. The stock market can feel like a giant casino, especially with all the hype and speculation online. It's easy to get caught up in the excitement of a hot new stock tip. But chasing after the latest stock without due diligence is like playing roulette with your money. You might get lucky once, but the odds are against you. Every stock represents a real company with real products and financials. Understand the business, its industry, and its growth potential before investing. We've all been there. You see a stock skyrocketing and you don't want to miss out. This fear of missing out, or FOMO, can lead to irrational decisions. Remember, just because a stock is going up doesn't mean it will continue. Chasing high-flying stocks can be risky. Instead, assess the situation objectively. Is this investment aligned with my goals? Do the company's fundamentals justify its valuation? Take a rational approach to avoid impulsive decisions and focus on sound investments. So how do you avoid falling prey to dodgy stock picks? It all comes down to one crucial factor: due diligence. This means thoroughly researching a company before you invest in it, just like you would research a property before buying it, or a car before driving it off the lot. Start by digging into the company's financials. Look at their revenue growth, profitability, debt levels, and cash flow. These metrics provide valuable insights into the company's financial health and its ability to generate profits and repay its debts. Next, analyze the company's management team, their track record, and their overall strategy. A strong and experienced management team with a clear vision can make all the difference in a company's success. Now, I know what you might be thinking. Graham, this all sounds great, but I'm not a financial expert. How am I supposed to know what to look for? Don't worry, you don't need to be a Wall Street whiz to conduct effective research. There are tons of resources available to help you, from reputable financial websites and investment platforms to educational books and online courses. Take advantage of these resources and learn the basics of financial analysis. Remember, investing is a marathon, not a sprint. It's about making informed decisions based on solid research and a long-term perspective. By taking the time to educate yourself and develop a sound research process, you can significantly increase your chances of investment success. Let's talk about diversification, a fundamental concept in investing. It's tempting to put all your eggs in one basket, especially when you know and love that basket. Maybe you're passionate about a particular tech giant or feel comfortable investing in real estate, but concentrating investments can expose you to significant risk. What if that company faces challenges or the industry declines? Diversification mitigates risk. Spread investments across assets, industries, and geographies to protect your portfolio. Think of diversification as a safety net for your investments. Just like you wouldn't want your entire financial well-being to depend on a single source of income, you don't want your entire investment portfolio to rely on the performance of a single stock or asset class. When you diversify your portfolio, you're essentially reducing the impact of any one investment on your overall returns. If one stock in your portfolio takes a hit, the other investments can help cushion the blow. This doesn't mean you'll never experience losses. That's just part of the game in investing. However, diversification can help smooth out the ride and protect your portfolio from catastrophic losses. So, how do you go about building a truly diversified portfolio? It's not as complicated as you might think. Start by investing in a mix of different asset classes such as stocks, bonds, and real estate. Within each asset class, diversify further by investing in a variety of sectors and industries. For example, within stocks, you might consider investing in technology, healthcare, consumer goods, and energy. Don't forget about geographic diversification. Consider investing in both domestic and international markets to further spread your risk. Remember, diversification is not a one-time event, it's an ongoing process. As your financial situation, risk tolerance, and investment goals evolve, so too should your portfolio. Regularly review your asset allocation, which is the percentage of your portfolio allocated to each asset class, and make adjustments as needed to ensure it aligns with your current circumstances and objectives. By embracing diversification as a core principle of your investment strategy, you can build a more resilient portfolio that can weather market storms and help you achieve your long-term financial goals. You're crushing it! You're picking solid investments, making smart choices, and staying ahead of the game. You've got your diversified portfolio humming along, spreading your risk across different assets, and ensuring that no single downturn can wipe you out. But there's a silent portfolio killer lurking in the shadows: fees. These hidden costs can be insidious, creeping into your investments and slowly draining your profits. Those pesky little fees in the fine print can add up to a mountain of money over time. We're talking thousands, tens of thousands, even hundreds of thousands of dollars siphoned away from your hard-earned gains. Imagine the impact on your long-term financial goals. Think of it like this. Every dollar you pay in fees is a dollar that isn't working for you, it's working for someone else. And the more you pay, the less you keep. It's like having a leaky bucket. No matter how much water you pour in, if the leaks aren't fixed, you'll never fill it up. Every fee is a tiny hole in your financial bucket, and over time, those tiny holes can lead to a significant loss of wealth. It's crucial to be aware of these fees and take steps to minimize them. First, let's unmask these fee culprits. Hidden costs can sneak up on you and take a significant bite out of your investments. Expense ratios in ETFs and mutual funds cover management costs. They might seem small but add up over time, eating into your returns. Trading commissions are fees you pay every time you buy or sell a stock. Frequent trading can make these costs accumulate quickly. Account maintenance fees, inactivity fees, and other charges can quietly drain your account, impacting your financial health. It's essential to be aware of these fees and understand how they affect your investments. Hidden fees like 12b1 fees or loads on mutual funds can be insidious because they're not always immediately apparent. These fees are often used to pay for marketing and distribution expenses, but they come out of your pocket. These fees might seem small, often expressed as a percentage, like 1% or even 0.05%. Over time, these small percentages can add up to a substantial amount, significantly impacting your investment returns. You might be thinking, what's 1%? That's nothing. But that seemingly insignificant percentage can balloon into a significant chunk of change over time. The compounding effect of these fees can erode your returns more than you might expect. Imagine this, you invest $10,000 and earn a 7% annual return. But if you're paying a 1% annual fee, your actual return drops to 6%. Over 30 years, that 1% difference could cost you tens of thousands of dollars in potential earnings. It's crucial to be aware of these fees and take steps to minimize them to protect your investments. Now I get it, sometimes convenience comes at a price. You might think, I'm busy building my empire, I don't have time to research every little fee. But trust me, a little bit of effort can save you a ton of money in the long run. Remember those actively managed mutual funds? They often come with higher expense ratios because you're paying for a fund manager to, well, actively manage your money. But here's the kicker. Studies have shown that most actively managed funds don't consistently outperform the market over the long term. So, you might be paying a premium for performance that you could potentially achieve with a low-cost index fund or ETF. It's like paying extra for a fancy sports car when a reliable sedan will get you to your destination just as well. The good news is you have the power to take control of your financial destiny by understanding and minimizing these pesky fees. First and foremost, read the fine print. I know it can be tedious, but it's crucial to understand exactly what you're paying for. Next, explore low-cost investment options like index funds and ETFs, which often have significantly lower expense ratios than actively managed funds. And don't be afraid to negotiate. Yes, you can actually negotiate fees with your broker or financial advisor. The worst they can say is no, but you might be surprised at how much you can save just by asking. Remember, Knowledge is power, and in the world of investing, understanding and minimizing fees is one of the most powerful things you can do to grow your wealth. Alright, let's talk about emotional investing. This one can really trip you up. You see a stock plummeting, maybe the market takes a dip, and suddenly you're hit with this urge to sell everything before it all goes to zero. I get it, it's a natural reaction, but trust me, it's almost always the wrong move. Remember back in March 2020 when the market tanked because of the pandemic? Everyone thought the world was ending and people were panic selling left and right. But those who held on, who didn't let their emotions get the best of them, they're sitting pretty right now, because the market rebounded, and it rebounded strong. Another emotion that can wreak havoc on your portfolio is FOMO, the fear of missing out. You see a stock skyrocketing, everyone's talking about it, and you feel like you're missing out on the once-in-a-lifetime opportunity to get rich quick. But here's the thing. By the time everyone's talking about a stock, it's often too late. You're buying at the top, right before it's likely to correct itself. It's like trying to jump onto a moving train that's already going full speed. You're much more likely to get hurt than you are to find a comfortable seat. Overconfidence can be just as dangerous as fear when it comes to investing. You might have a few wins under your belt and suddenly think you're the next Warren Buffett. You start making riskier bets, ignoring red flags, and convincing yourself that you can outsmart the market. But the market has a way of humbling even the most seasoned investors. It's important to stay grounded, to remember that no one has a crystal ball, and that even the best investors make mistakes. So, how do you avoid falling prey to these emotional traps? The first step is awareness. Recognize that emotions play a huge role in investing, and that you're not immune to their influence. Once you're aware of the potential pitfalls, you can start to develop strategies for mitigating their impact. One effective strategy is to have a clear investment plan and stick to it, no matter what the market is doing. This means defining your investment goals, risk tolerance, and time horizon up front. It also means diversifying your portfolio across different asset classes to reduce your overall risk. Look, you wouldn't start building a house without a blueprint, would you? Of course not. That's just asking for disaster. The same goes for investing. Without a clear plan, you're essentially throwing darts blindfolded, hoping to hit the bullseye. A well-defined investment plan acts as your roadmap to financial success. It outlines your goals, your risk tolerance, your time horizon, and your investment strategy. It helps you stay focused, disciplined, and on track to reach your financial objectives. Risk tolerance is crucial for any investment plan. It's the foundation of your strategy and can make the difference between achieving your financial goals and falling short. It refers to your ability to handle market fluctuations without panicking. Market volatility is inevitable, and your reaction can significantly impact your investment outcomes. Some people thrive on high-risk, high-reward investments, while others prefer stable, low-risk options for peace of mind. There's no right or wrong answer, it's about what you're comfortable with. Your risk tolerance is personal and influenced by your financial situation and goals. Be honest with yourself about your risk tolerance. Self-reflection helps you make informed investment decisions. Constant stress about investments can lead to poor decision-making and derail your plans. Think about how you'd react if your portfolio lost 10, 20, or 30% of its value. Your reaction indicates your risk tolerance. Understanding your risk tolerance helps create a balanced investment strategy that aligns with your comfort level and financial goals. Diversification is one of the most important concepts in investing. It's essentially the idea of not putting all your eggs in one basket. By spreading your money across different asset classes, sectors, and geographies, you can reduce your overall risk and improve your chances of achieving your financial goals. Think of it like this: if you invest all your money in a single stock, and that company goes bankrupt, you lose everything. But if you invest in a diversified portfolio of stocks, bonds, and real estate, the impact of a single company's failure will be much less severe. Having a plan is great, but it's useless if you don't stick to it. It's easy to get sidetracked by market noise, emotional reactions, and the latest investment fads. But the key to long-term success in investing is discipline and patience. Remember, investing is a marathon, not a sprint. There will be ups and downs along the way. There will be times when you're tempted to deviate from your plan, to chase returns, or to panic sell. But it's crucial to stay the course, to trust the process, and to remember why you created the plan in the first place. There you have it, guys. The top 5 investment mistakes to avoid in 2025. Remember, investing can be intimidating, but it doesn't have to be. By avoiding these common pitfalls, doing your research, and making informed decisions, you can set yourself up for financial success. Don't let hype, emotions, or lack of planning derail your investment journey. Remember, slow and steady wins the race. Focus on the long term, stay disciplined, and you'll be well on your way to achieving your financial goals. As always, thanks for watching, and I'll see you in the next video.